Hi friends, this is Ravi Kanth Miriyala. I wanted to take a quick revision class for accounting standards, which will be useful for CA Inter Advanced Accounting just before examination. If you just run through this video, that will be more than sufficient to answer your 30 marks of MCQs, and you will get a lot of confidence. That much guarantee I can give it to you. Okay, yes, let's have a very quick revision, and I will be covering each and every important point of all accounting standards. Right. Before getting into the revision, I just want to inform you about these things. Right. This is Advanced Accounting Made Easy, which is my book, and this is like 19th edition is going on. Maybe very soon 20th edition also will come. Okay, and this is helping thousands and thousands of students, lot and lot. I can suggest you this. This will be very helpful. Right. At the same time, yes, I have my advanced accounting classes for CA Inter, for CA Final, and for CMA Final. This advanced accounting classes, see, I'll teach not by the sums or something. It is like conceptual oriented classes. You will be enjoying the subject without any doubt. And whatever you learn, that will be very much useful during your articleship time. If you are interested, yes, you can contact under below in number. That is, first number is mine, and I mean both the numbers are mine. You can contact me, you can WhatsApp me, and yes, you can be in touch in case if you are requiring either books or the classes. Okay, right. And let's get into the subject. See, before getting into the accounting standards, first you must know what is the applicability. Accounting standards are applicable to each and every entity, irrespective of its form or activity or orientation. Okay, right. It is applicable to every entity which is preparing the general purpose financial statements. Right. Yeah. So at the same time, is it applicable to? There is only one exception. If the company is into non-profit organization, then and if it is a non-profit organization, then it doesn't need to 100% non-profit organization. It does not need to does not need to comply with accounting standards. At the same time, general purpose financial statements obviously include the balance sheet, profit and loss, cash flow statement, notes to financial statement, statement of changes in equity, SOCIE. Okay, just remember these things. And every accounting standard is being divided into 5 parts. Okay, one is objective, the next one is scope, next one is definition, next one is recognition and measurement. What do you mean by recognition? When to record asset. Okay, and what to record, that is going to be taught by recognition paragraphs. Measurement, how much to record. Next, presentation, where it should be presented in the balance sheet or profit and loss or cash flow or notes, where it is supposed to be presented. And disclosure, disclosure is additional information about the presented items. Okay, these five are the parts of every standard. You will find it in every standard. And one more very important definition, that is what is an asset. Asset is a resource which is controlled by an entity arising from the past events, expected to give you a future economic benefits inflows to the entity. So when do you recognize an asset? Asset will be recognized when you satisfy both the two conditions. What is the first condition? There should be probable future economic benefits inflow, and it should be measured reliably. What is probable? Probable means more than 50% chance. That is more likely than not. Then only you should be recognizing asset. Same way, what is a liability? Liability is a present obligation arising from the past event, expected future economic benefit outflow from the entity. When do you recognize a liability? When you satisfy two conditions. When there is a probable future economic benefits outflow, at the same time it should be measured reliably. Okay, yeah. So that's on the next third item. That is what every balance sheet is divided into 3 parts, which you have studied already. Correct. Now one is equity, liability, and asset. We learned what is asset, we learned what is liability, only what is equity. Equity is residuary interest in net assets. Yeah, that is assets minus liability is nothing but equity. What is equity? Equity is nothing but the shareholders, I mean the owners' contribution, I mean owners' interest, basically. Okay, and one more important definition, which is income. What is income? There is a very broad definition by the framework. One is increasing the future economic benefits, that is nothing but increasing in the assets or decreasing in the liability, ultimately increasing in the equity, other than contribution by the owners. That's what, if you issue the shares, there will be increase in equity, increase in asset, but it doesn't need to be income. That's why they said excluding contribution by the owners. What is expense definition? Exactly ulta. that is decreasing in the assets or increasing in the liability. Ultimately, there is a decrease in the equity, other than distribution to the owners. Okay, dividend payment is not an expenditure. Okay, these are the very basic things I have covered. Next, let's get into accounting standard 1, disclosure of accounting policies. Okay, what is that you're learning in this discount? This is a very small standard. Very quick revision will be more than sufficient. What is the first thing you should learn? Disclosure. Where do you disclose? In notes to financial statements. What do you disclose? Accounting policies. Do you disclose everything? No, only significant accounting policies are supposed to be disclosed. What is an accounting policy? Accounting policies are accounting principles, accounting methods, accounting conventions. So many words people use which are adopted by the entity in preparation presentation of financial statements. There are number of policies are available. Out of that, what you have taken by your company, what is taken by your company, that is that company's accounting policy. Okay, how do you select the accounting policy? There are two considerations. One is primary consideration. Next one is other major consideration. Otherwise, secondary consideration you can call it. Primary consideration. What is primary consideration? The selected accounting policy should give true and fair view to financial statements. Okay. What about other considerations? Secondary considerations are prudence, substance over form, materiality. What is prudence? Prudence is a wisdom that should be applicable, suitable to your company based on your business. Substance over form, that is legality, correct? Reality over legality. Whatever you are selecting, that should be suitable to the situation. I hope you understand. Correct. Right. What is reality? That should be reflected by applying the accounting policy. Such kind of policy should be selected. Materiality. For every material item in the financial statements, this accounting policy has to be selected and that should be appropriately disclosed. And these are the disclosure of accounting policies. As we said, all accounting policies should be forming part of financial statements. All accounting policies should be placed at one place. That's why in the notes to financial, we'll write significant accounting policy 1, 2, 3, 4, 5 like that. We'll be disclosing. It should not be scattered in the financial statements. Next, disclosure is never a remedy for a wrong or inappropriate accounting. This you need to remember. And one more important point of this standard is fundamental accounting assumptions. What are the fundamental accounting assumptions? There are three fundamental accounting assumptions. You need to disclose it. You don't need to disclose it. You do not need to disclose if you are following all the three fundamental accounting assumptions. If you are not following, yes, you have to disclose it and you have to consider the accounting also if it is necessary. What is the first fundamental accounting assumption? One is going concern. Yes, it is assumed that the entity is going to continue over the life, right? And it's going to continue. If you have a doubt on that, then you are supposed to disclose the same thing and you are supposed to measure the assets and liabilities at its NRV, net realizable value, or on liquidation basis it is supposed to be created. It is supposed to be, land. What is the NRV? That NRV only is supposed to come in the balance sheet. Sir, my value is equal to 1000, NRV is equal to 800. Yes, you should transfer the 200 rupees to profit and loss. It may be gain or it may be loss. Consistency. Consistency is nothing but it is assumed that previous year whatever the accounting policies you have followed, same thing is continued in the current year. If it is so, you don't need to disclose it. If not so, then you are supposed to disclose. Then you have to give information what policy is changed, why it is changed, what is the financial impact because of the change, and okay, right? If you are not able to measure the financial impact, you have to tell what is the reason. Correct. And the current year there is a change in the accounting policy, but because of the change, impact is not coming only in the current year. If it is going to impact future years also, that also you are supposed to disclose it. You have to disclose it in the notes to financial statements. Accrual concept. Accrual concept is exactly opposite to cash concept. Whenever the transaction takes place or occurs, that time it is supposed to be accounted for. That means irrespective of the cash inflows or outflows, transaction taken place or not, yes, that is supposed to be accounted for. Hope you got it. Yeah, now let's get into accounting standard 2, valuation of inventories. Yeah, first, what is inventory? Correct. Now, what is inventory? Inventory is an asset which is held for sale in the normal course of business or which is used in the process of production for such sale. So which includes obviously, which will be included, raw material will make into FG, WIP will make into FG. Next, inventories are those which are to be consumed in the process of production. What are which are consumables, that is consumable, use tools and etc. things are going to be part of inventory. See, if you have this exact knowledge of the definition also, then only you will be able to answer those MCQs. Let them twist whatever the way they want. If you don't know the each word and everything, no, then you will be get caught very easily, very easily. Okay, right? How do you value the inventory? As you very well aware, which is cost or NRV, whichever is lower. Now the entire standard talks. What is entire standard has only three topics. One is cost. Next is what is NRV. Whichever is lower, how to identify. That's all. How to identify, don't you know? You know it, but there is one small point which we'll discuss towards the end. Okay, right. What do you mean by cost? Cost of inventory. Cost of inventory basically has three things. One is cost of purchase, cost of conversion, all other costs to bring the inventory to the present location and condition. Okay, what is cost of purchase? What all the material you are purchasing? Okay, what will be it including? Purchase of raw material. Purchase of raw material will be including freight duty, correct, freight charges and unloading charges, and any taxes which is non-refundable taxes, brokerage commission, all other costs to bring it to the warehouse, right? Minus if there is any discounts, quantity discount, trade discount, whatever kind of discount, duty drawbacks also going to be reduced. This is cost of purchase. And what about cost of conversion? See, cost of conversion basically will happen from the labor and from the overheads, right? Labor is obviously like a variable overhead. How do you allocate labor? That's based on the actual capacity. And what about the fixed overhead? Fixed overhead will be allocated based on either actual capacity or normal capacity, whichever is higher. What is normal capacity? That is the number of goods that you can produce it under the normal circumstances, considering normal wastage of time, breaks, holidays, maintenance time, and everything. Okay, and the third thing, what is that we told? All other costs to bring the asset, to bring the inventory to present location and condition. Correct. Now, what will be? Yes, quality control cost. Quality control cost is not to make it. After making the asset, you will check it. Correct. Now, yes, but still it is going to be part and parcel of, because after quality control only it will be ready for sale. Next, development cost. Yes, administration cost. Administration for the production activity. General administration of the office, head office is not supposed to be taken. Administration of the factory is supposed to be taken. Primary package is supposed to be considered. Secondary package cost is not supposed to be considered. Primary package should be considered. Mobile is sold, then that mobile box is supposed to be, cost of mobile box should be taken, but the entire cartoon box where you keep like 50-60 mobiles, that is not supposed to be considered, right? Which costs are not supposed to be part and parcel of the word cost? One is abnormal waste. Right, abnormal loss will never be part and abnormal waste of raw material, labor, overheads, anything will never be part and parcel of any asset. Inventory is also asset. Next, storage cost. No, that is raw material storage or finished goods storage, then storage cost, because storage does not add any value to the inventory. Unless until if the storage is the part of production of process, no, otherwise it should not be added. General administration overheads, as I told you just now. Selling and distribution overhead. Selling and distribution is incurred after the inventory is ready for sale, because that's why this cost will never be included. Any interest and financial charges, no, interest cost and any other finance cost also is not going to be part and parcel. But if the inventory is a qualifying asset as per accounting standard 16, then yes, it is going to be considered, otherwise it will never be considered. Okay, right. In case of joint products and byproducts, when do you say it is a joint product? Generally it's based on the materiality. If the two items are going to be valuable, then we'll call it as joint product. And if there is one more item where the valuation is very less, then it is going to be called byproduct. How do you value the byproduct, sir? Generally byproduct is not considered as an inventory. That's why it is going to be treated, it is going to be valued at NRV, and that NRV value is going to be reduced from the total cost. The total cost value is going to be bifurcated between the, all right, joint products. So how do you bifurcate this? This is based on the selling price of the joint product immediately after separation. Sir, selling price is not available. Okay, then if there is any further process has been done, then selling price of the after further processing minus further processing cost is going to be reduced. That will be considered selling price of after immediately after separation at the rate will be taken. Suppose further processing cost is negligible, sir. Then selling price of the final products is going to be considered, which you have learned it in costing already. Okay, right. Then cost formula is one more. Cost we are saying how do you determine? Before you decide what is the cost formula, whether the items are interchangeable. Okay, if you are making some item which is specific to each person, it is different. I add order based, you have manufactured. Under that circumstance, LIFO, FIFO and all will not work. So specific identification method is supposed to be followed. No, sir, items are interchangeable. Yes, then under that method, either FIFO method or weighted average method or standard cost method or retail cost method, any method can be followed. If you follow standard cost method or retail cost method, it is supposed to be revisited. You need to review it every year, whether last year whatever the standard cost I have followed or retail cost I have followed, does it make sense in the given circumstance in the current year? That is supposed to be tested by you people, okay, every year basis. Then second topic is net realizable value. What is net realizable value? Net realizable value of the finished goods is going to be expected selling price minus expected, I mean, selling cost. If you are supposed to incur any cost to sell the item like brokerage, commission, something, it is supposed to be reduced. What about NRV of the WIP? NRV of the WIP is expected selling price of the FG. Remember the expected selling price of the FG minus expected selling cost minus cost to complete it, to turn it to FG. How much more money is supposed to be incurred, that is supposed to be reduced. Then that is the NRV of WIP. Right. And with respect to raw material, actually NRV of the raw material is not at all required to compute. Why? Because raw material is not meant for sale. It is meant to produce a finished goods, and finished goods is ultimately going to be sold. Correct. So that's why raw material ka value, how do you determine? Just first thing, what is the FG? Whether the FG is going to be sold at cost or above cost. If you say FG is going to be sold at cost or above cost, then raw material should never be compared with NRV or anything. Raw material will be valued at its cost. No, sir, FG is going to be sold below the cost of FG is going to be sold below the cost. Then value of the raw material should be taken as a replacement value. Replacement value means immediately, I mean, if same kind of item, if I buy it in the market, how much does it value to me? That valuation is my existing raw material value. Okay, right. And before going to the third cash flow statement, my dear, one more top point, whichever is lower, I told you. When you are calculating cost or NRV, whichever is lower, you are not supposed to take the sum of all the raw materials, sum of all the, no, should not do. Each raw material A. Yes, cost or, I mean, finished goods, you say the finished goods A, I mean cost or NRV, whichever is lower. Next, finished good B, cost or NRV, whichever is lower. Like that you are supposed to do. You should not do grouping. Group wise you are not supposed to perform cost or NRV, whichever is lower. I hope you have understood. Okay, now let's go to the next standard, a cash flow statement. See, this is actually a practical thing which you are supposed to I mean solve the sums. But yes, I'll try to do little very quick revision about this. So cash flow statement, yes, important things about MCQ questions and everything. What is cash? Cash means cash in hand, cash in bank, and all demand deposits with the bank. Demand deposit with the bank means whenever suppose I have the money, if I go to bank and say yes, if I sign, please give me my money, means banker is supposed to give you. Banker cannot say that no, will not give you now. You should come later. No, demand deposits. I should get the money on demand. Next important thing is cash equivalent. Whenever you want to say it's a cash equivalent, it should satisfy two conditions. First, it should be short-term, highly liquidable investments. Correct, readily convertible into cash. Yes, equity shares are will satisfy, because if it is a listed equity share, I can sell whenever I want. But listed equity share cannot satisfy the second condition. What is that says? Conversion when you are converting into, that should be insignificant change in value, insignificant risk of change in value. If I invested today 1 lakh, Tomorrow if it comes to some 10 rupees, 100 rupees, if it comes down, that's not a problem. But if you invest in equity shares, the value of the share may fluctuate like anything. There is a significant risk of change in value. That's why investment in shares, marketable securities, generally should not be considered as cash equivalent unless until if the question says. Yes. Cash flow statement. Yes, cash flow statement. The entire cash activities of the company are going to be divided into three. One is operating activity, investing activity, financing activity. What is operating activity? Which is related to my principal revenue generating activity, that is generally like from sales purchases of my business, basic business, correct na? Revenue, goods purchases, services related. Not only that, it includes the residuary activities. Residuary activity in the sense, if it is an activity does not fall under investing activity, it does not fall under financing activity, then it is going to be part and parcel of operating activity. What is investing activity? Investing activity is purchase and sale of fixed assets and investments and any income from the investments also. Okay, financing activity. Financing activity is a change in the capital structure, I should say. That means issue of equity share, buyback of equity share, issue of preference shares, redemption of preference shares, issue of debenture. Yes, redemption of debentures, okay, taking a loan from a banker and repayment of the same loan. Not only that, and cost of such things, cost of such structure in the sense, what I mean, for if you have equity share, then you have to pay dividend, preference shares, preference dividend. If it is a debenture or loan, you are supposed to pay interest. Yes, payment of interest, payment of dividend is going to be financing activity. Okay, at the same time. Yes, so cash flow statement is one, but cash flow statement will vary in one with respect to operating activity. There are two methods. One is direct method, next is indirect method. Right. Insurance company will follow direct method mandatorily as per the IRDA Act. Correct. Now, all other listed companies are supposed to follow mandatorily the indirect method. Okay, right. And other companies have got an option whether if you want to follow direct method or indirect method. But practically everybody follows indirect method, because practically when you are trying to solve this, no, indirect method will be very easy compared to direct method. So how does the direct method look like? Direct method means, I mean, what are the direct cash flows from sale of goods, from cash flows that may be inflow or outflow, correct? Now, from purchase of goods, purchase of services, or sale of services, or salary payments, any other expenses payment, we'll write plus minus, we'll write it. Then towards the end, we'll always present income tax separately. Then minus income tax payment, minus any extraordinary events, any plus or minus is there that is supposed to be considered. In case of indirect method, it will start from the net profit before taxation, extraordinary item. Then for that, we'll be doing either plus or minus any non-cash and non-operating items, depreciation, profit or loss on sale of fixed asset, on sale of investment, any interest income, interest expenditure, dividend income, right? Those items are going to be done like this. Any ESOP expenditure, because ESOP is not a cash outflow actually, that's why that is also going to be done. Then any changes in the operating capital, working capital, you can write it, that is increase in the current assets, decrease in the current assets are going to be considered. Then you will be reducing the income tax payments, then plus or minus any extraordinary items if you have, that is going to be considered. That is how operating flow, cash flows from operating activities under indirect method is going to be derived. Some of the important points I would like to cover. Income taxes. Income tax payment is generally considered as an operating activity unless until specifically mentioned. A capital gain from sale of land, a fixed asset or investment, if like that, if it is said, then only it should be taken as an investing activity. Otherwise it should be taken as an operating activity only. Right. Cash flow from foreign currency is the date on which the cash flow is received or paid. No, that date of transaction is supposed, that date rate is supposed to be considered. Loans and advances given. Okay, loans and advances given to subsidiary, investing activity. Loans and advances given to supplier, it is operating activity. Loans and advances given to employees, operating activity. Loans and advances taken from customer, operating activity. If it is taken from subsidiary or parent company, it is an financing activity. Okay, yeah. If it is loan taken for a financial enterprise like a banker, it is an operating activity. For a non-financial entity, loan taken financing activity. Hope you understood. Yeah. If there is any non-cash items like convertible debentures are converted into correct converted, right? It is a non-cash item. What should I do? You should disclose it. Where should I disclose it? It is immediately below the cash flow statement. Not necessary. It can be disclosed anywhere in the financial statements. It should be disclosed as part of your notes to financial statements. Okay, my dear. Let's get into accounting standard 4, contingencies and events occurring after the balance sheet date. Even though the contingency word is there, all these contingencies are covered by accounting standard 29. Now, the events occurring after the balance sheet date. Which events? Only significant events occurring after the balance sheet date. Yes, after 31st March. After 31st March, till what date? Till the financial statements are approved by the board of directors. The events between 31st March to till the board of directors approval, whatever the significant events happen, whether it should be considered as part of the, are you going to adjust it in the last financial year or are you going to take it in the current year? So these activities are basically, the activities between 31st March and the approval by the board of directors are supposed to be divided into two kinds of activities. One is adjusting events, next is non-adjusting events. What are adjusting events? These adjusting events are situations or conditions which are already existed as on the balance sheet date. The events occurring after the balance sheet date give what? Give the information. Okay, additional information with respect to the conditions which were lying already on 31st March. Okay, right. So it was already, suppose there was a case. Subsequently, it was, judgment has come that we are supposed to pay the money. Yes, the case was already there as on 31st March. We were not aware about correct. I was liable, but I was thinking that I was not liable. Got it. Correct. I made a provision for bonus 100 rupees, but subsequently I paid 150 crore rupees of money. Correct. Now, so 50 crore extra I have paid up. Yes, that was a liability which was there as on the balance sheet date because whatever I have paid is pertaining to the last financial year. Correct. Now, to the employees which relate, for their work of the last financial year. So I have recorded initially at 100 rupees. Subsequently, I got to know that I paid 150 extra. That 50 is supposed to be adjusted in the previous financial statements itself. Got it? Right. If it is a non-adjusting event, suppose subsequently some sale has happened. Okay, subsequently I have declared a dividend. Dividend was never a liability as on 31st March. Dividend was not correct. Now, correct. Suppose subsequently proposed dividend for the last year, even that is proposed dividend, but it was not a liability as on 31st March. That's why it is considered as non-adjusting event. If it is a proposed dividend, it is supposed to be, it should be disclosed. Where should I disclose? In the notes to financial statements, because Schedule 3 very specifically says. But other than the proposed dividend, if there is a non-adjusting event other than proposed dividend, that should be disclosed only in the board of directors report. Proposed dividend is a special point which is required as per Schedule 3. Okay, right. For this above explained rule, there are two exceptions. What do you mean by exception? Even exception means even though the item is non-adjusting event, still it should be considered as adjusting event and it should be accounted for as on 31st March. When will this happen? One, when it is a statutory requirement. When law says no, it should be adjusted for. Yes, even though it is a non-adjusting event, we should go and book. But there is no example, there is no such point available in the law as of now. Okay. And what about the events occurring after the balance sheet date, but affecting the going concern assumption of the entity? If it is affecting the going concern assumption of the entity, even though that event subsequently happened before closure of the books, you should account it as if it has happened already as on 31st March. If it is affecting the going concern, then as I discussed just now, as per accounting standard 1, you are supposed to you are supposed to measure the assets and liabilities at net realizable value. Any gain or loss on such measurement should be transferred to profit and loss statement. Okay, that's all. This is a very small standard which you have completed in very short time. Right. Let's go to the next standard. That is accounting standard 5. Yes, it has got basically three topics in the name. One more topic is also there. First one, net profit or loss for the period prior Net profit or loss for the period. That is the topic number one. Prior period items. Topic number two. Change in accounting policy. Topic number three. Change in accounting estimations. That is topic number four. Yes. Let's see what is net profit or loss for the period. Yeah. So net profit or this is the basic information. Net profit or loss in the period, in a sense, the entire activities of the business are going to be classified into two. One is ordinary activity, one is extraordinary activity. What is ordinary activity? Ordinary activity means these are activities arising from the normal course of business. Okay, normal course of business which are expected to occur. Correct. The frequency is generally high, which is expected as part of the business. Right. Then it is considered as ordinary activity. Okay. Sale of fixed asset. Is it ordinary? Yes, it is ordinary. Because when you purchase fixed asset, when the life is over, when that is not required for the business, obviously we'll sell it. When you sell it, you will get either profit or loss. So that is not extraordinary, not expected out of correct. It's not expected, not imagined. Business means business. You don't sell the fixed assets on daily basis, but sale though will happen obviously. Okay. Next, what is extraordinary activity which is not expected to occur as part of my business? Okay, some earthquake has happened, you got loss. Some suddenly fire accident, you don't deal with fire, but fire accident occurred, and yes, you lost something. So these are not happened because you are doing the business. So these are extraordinary activities. So if it is extraordinary activities, what should I do? Nothing, my dear. You are supposed to disclose separately on the face of financial statements. I'll show you in one of the slides how will it be presented. Okay, right. Ordinary activities are do I need to show separately? Yes, every ordinary activity does not require a separate disclosure, but some of the ordinary activities which are called exceptional items. So how do you what are those exceptional items? Which are based on the size, which are based on the size or nature or incidence of the transaction. Size, it's a huge, sir. I sold some, yeah, fixed assets only I sold, sir. Huge profit I got, sir. Oh, huge profit. It's material. Yes, then it requires a separate disclosure. Separate disclosure, that is a judgment of the company and judgment of the auditor. Got my point? That is not you and me judgment. Right. So then it is considered as exceptional items. It is nature is different. Yes, sale of fixed assets is not my routine business. At the same time, the value is huge involved. Then I would like to show it separately. Yes. You are welcome. Impairment of fixed asset as per accounting standard 28. Yes, it is an exceptional. Impairment loss will not happen on daily basis. Right. And we have the standard has given these following 7 points. You please remember all these 7 points, my dear. Writing down of inventory NRV, if it is a huge amount, that is important. See, one of the client was arguing. So you written right NRV written. So NRV written how much is the amount? 20,000 rupees. 20 he wanted to show separately. I was about to say you dash fellow. 20,000 is nothing. The company has 200 crores of sales, my dear. 20,000 is chiller, yeah. Where do you want where do you want to show that separately? So you should apply basic sense. Correct. Now, if there is any restructuring activity, these are all exceptional activities, not extraordinary activity. Profits or loss on sale of fixed assets, or profit or loss on sale of investments. Okay, yes, legislative changes with retrospective implication, litigation of any litigation settlements, or any provision creation, provision reversal will never be extraordinary activities. These can be considered as exceptional activities considering the size and nature and the incidence of the transaction. This point you need to remember. You have to remember. Okay, right. So prior period item. What is prior period item? Prior period item definition itself says prior period item is an income or expenditure related to last year but recorded in the current year. Why it is recorded? Because of an error or because of an omission. What is an error? Error can be a mathematical error. Error can be a wrong application of accounting policy, or error can be wrong interpretation of facts. Correct? Na? Error can be even a fraud. Correct. Yes, error doesn't mean like not like auditing. My error is not equal to fraud. No, no, here error is also fraud, also error only. What do you mean by omission? Omission means information was already available at the time of preparation of financial statements, but still was not considered. Maybe because of the oversight or somehow it is missed out. Then it was already available but was not considered in the preparation of financial statement. Then that is called omission. Okay, next topic is change correctness. Sir, if it is a prior period item, what should I do? If the prior period item is material item, then it is supposed to be disclosed separately. How should I disclose? Yes, you should calculate all the profit before profit before tax, profit before tax you have to consider from the current year activities. Then you should say this is the prior period item profit or income or expenditure. Income or expenditure number you are supposed to keep it, because this is not pertaining to current year. If you mix it with the current year, people understanding of the current year performance of the entity will obviously go wrong. Okay, right. So the same change in accounting estimation. So how does it? What is change? Change in estimation. Estimation itself means what? Approximation. Okay, approximation means obviously see many numbers in the financial statement can never be measured accurately. So as depreciation estimation. What is the life of fixed asset estimation? Fair market valuation estimation. Correct. Now, almost all the numbers in the financial statements are estimation. Somehow or other thing it is included. Right. So when do you go for estimation? When I don't know exactly what is accurately correct, I'm not able to measure. Right. So what should I do? If it is a change in estimation is taking place, yes, prospective accounting is supposed to be done. What do you mean by prospective? From now onwards, it is supposed to be considered. So change in life of asset, yes. Whatever the remaining WDV, the remaining WDV should be depreciated over the remaining life of the asset. Okay, so change in the depreciation method. Yes, depreciation method also is an estimation. Yes, whatever the remaining WDV should be depreciated over the new method. It is change in depreciation method is not a change in accounting policy. It is a change in estimation. Okay, if it is estimation, is impact is huge. A big change is taking place. Then you need to present it separately. You need to disclose it. Disclose the information notes to financial statement. Next point: change in accounting policy. Accounting policies, can it be changed? Yes. Accounting standard one says it should be followed consistently, right? But it can be changed in three circumstances: when it is required by the law, when it is required by the accounting standard, when it is required for the better presentation of the financial statements. So can I change it? Yes. So if you change it, correct. Now what is the example, sir? FIFO method 2, weighted average method. Cost model of measurement of PPE to revaluation model. Any such kind of thing. Okay, right. Then got my point. At the same time, this following two things which I am trying to tell does not amount to change in accounting policy. Okay, right. If last year you were following ad hoc method does means what? There was no method exactly. But current year you created a new policy. Adoption of a new policy does not mean a change. Change means what? You must be following something. You removed that and you brought a new policy in that place. Replacement is what change. Correct. Nothing is there. First time I am following something doesn't amount to change in accounting policy. Sir, how should I account for? Actual accounting standard 5 is silent. You are but considering the IFRS or Ind AS, which is followed in the country by all big companies, then you follow retrospective application of accounting policy. But you will not restate the previous year financial statement. We do not change the previous year financial statement, but we will calculate like as if the new policy is followed from the beginning. The impact is going to be charged to the current financial year. Right. Let me just depreciation method. I told you it's a change in estimation. Change in life, change in estimation. Mathematical error, yes, prior period error. Fixed assets destroyed in the earthquake. Earthquake, it's not because of myself. That is extraordinary item. Major disposal of fixed asset. Ordinary item, but if the impact is based on the size, nature, and incidence, I told, if it is so big, then it is going to be considered as exceptional item. This is the way of presentation. If you observe carefully, correct na? Profit before exceptional and extraordinary item is given, then extraordinary item first will be reduced, exceptional item will be reduced, prior period item will be presented something like this, then it will be tax expenditure, net profit after tax is going to come like this. Okay.